John, yes. There we
The
go.
Money Show.
Yes, there we go.
Personal finance.
That's the one. That's the one, you see, John. There we
No,
go.
no music, no talk.
No music, no talk. We don't. We. That's our payment. I mean, with the piper that plays the tune, all of that. Now, Warren, listening to Colin Coleman, you've got to have a bit more spring in your step than when you came up with this idea of the topic for conversation tonight. Although Colin Coleman does acknowledge there are risks and some fairly significant ones.
There are, and I think if I have to just listen to what's going on in the country now, with no special insight that he has, I almost feel that the country is in a lot better position than we were 12 months ago. And certainly a lot better than we were 24 months ago. And that's despite the fact that we've lost, two quality finance ministers in that time. And for me, it's simply because I think a lot of this muck is now out in the open. And I think it's very hard for people to kind of carry on with this mass corruption, in the spotlight. And I keep thinking, if you're a company that, one of the large businesses that's been party to all of this, and you've got even a tiny little representative office sitting in America, you have to know that that somewhere along the line someone's going to go to jail, and it might not be here, but it will definitely be in America. And so that I agree with him. I think we are in a better position.
Now, not all of us have got 50 years to wait for an investment to recover or realize its value. But you've seen a graph I've got which sort of pinpoints the various calamities that South Africa has faced over the last 50 odd years. Everything from Sharpeville to Verwoerd to Forster to oil crises to the Soweto uprising and the consequences of that, and the mass exodus of young South Africans into exile, the P.W. Botha era and the Rubicon speech, and the 9/11 attacks, and even something as big as the world economic crisis, and the fallout as a result of Nene Gate and the sacking of Pravin Gordhan. All of these massively calamitous events that happen one at a time feel like absolute disasters, but in the fullness of time, over 10, 20, in this case 50 years, they're barely blips on a graph of long-term returns. When it comes to looking ahead to a conference like the ANC's elective conference in December, should investors even care?
I saw a couple of people, when we put it out on Twitter what we were going to talk about tonight, a few people saying, investors, if there's no elective conference and there's nothing to worry about, and do your normal maths, do your normal investment decision making. And I think there is merit to that argument. However, I'm always wary of using the phrase "this time it's different" in investments, because inevitably it's not. But I do think one needs to be cognizant of what's going on, because we are at yet another inflection point in our history, and I think you could, if you ignore these ignore these events, the consequences of these events, if they don't go well, as Colin says, the good guys don't win. That we could be in for a more sustained, prolonged period of muted economic growth, greater unemployment, etc. And so your sort of medium-term outlook could suddenly become a very long-term outlook, not overnight, but within 24 months. So I think we have to be cognizant of these things.
All
but
right,
I'm not saying we're at a cliff, and it's either off a cliff or over the bridge. I'm not saying that. I think you just have to be cognizant.
Okay, so being cognizant, then, does being cognizant require you to take action, to make decisions, or does one just sit there being cognizant and do nothing?
No, I don't think you'd. I certainly think this time you don't do nothing. I think you do always start, and I'm always the broken record in this, with your own situation, where you need to be, how you should be investing, and if there are adjustments to be made in your own position, then that's when you look at the current situation and the next 24 months, and then use that as an opportunity either to tread more carefully, more slowly than you might have done in the past, or to restructure and be somewhat more conservative now than possibly you might have been, or lastly to take some of the greater risks that you've had in your portfolio, to take those risks off the table to an extent, with a view to seeing what's going to happen. But I certainly wouldn't be in this situation. If I listen to some of the questions I've had, some people saying, why don't we just sit in cash and sell out our equity exposure and wait for this all to pass and then make investment decisions? I think that's a bad decision. I think if we've just seen what's happened to the JSE in the last few months, it's going up rather strongly now, and that certainly would jump very quickly if the good guys did win. And unfortunately, you can't then decide to jump in the market. It would have shot ahead of you already. And I think the other big question on everyone's mind, if the questions I get are anything to go by, is the sort of the local versus international. And again, I certainly wouldn't be taking every cent I have and sending it out now, in the anticipation that everything's going to go south and the rand's going to be at 30 to the dollar in weeks or months' time. I think that's also a mistake.
Okay, so what do we do?
I think I just wanted to talk through some of the dangers of trying to invest in anticipation of an election, because I think we've had some great examples from the Brits and the Americans recently, and how difficult it actually is to get all of this right. So if we're going to look at an election, number one, you have to get the outcome of the election right. You have to be accurate in terms of who's going to win. And let's just look at Trump as an example. I would say most investment people and most people in the media were massively surprised that Trump actually won. So firstly, you as an investor, you have to be right there. And then secondly, you have to anticipate what other people are predicting. So the fact that you're right doesn't mean that everyone else is going to be right. And in that instance, even if you predicted that Trump was going to win, you have to predict what other people are thinking. And if we stay with Trump, then most of the investment market was wrong. And thirdly, you have to figure out how markets are going to react to all of this. And if we look at what happened in the American stock market from the time that Trump was elected, it would confound, I think, most rational thinkers about this, because it went up, and it went up very strongly. And so, I think if we take all of that and we look at the South African context and say to yourself, what's going to happen here and how do I make money or not, or avoid losses, you've got to be very careful of kind of an either or thinking.
You keep telling us what we mustn't do. I want to know what we must do.
So I think I maintain that you need to have a healthy exposure to South African assets and particularly our growth assets. So inevitably that comes down to South African shares and South African property companies, especially the listed ones. I think a lot of the South African market has been, deeply discounted by what's going on in our economy and the politics, and so there's still good value there, and I think we're starting to see some of that unlock recently, and if you look at the South African property companies, in other words, not the overseas companies that are trading on the South African Stock Exchange. These are companies that really do trade here. There's been so much bad news, but if you look at the income that you can get from those companies, they're offering attractive yields now. So to me, it's silly to avoid that because we're worried about the political situation. At the same time, I would have some at least a toe or a foot in the international markets. But again, don't send your money out at any exchange rate. I still think, and I've been fairly consistent since January last year, that if you're doing it from rands to dollars, that 13 Rand 50 is a key level for me. And if it's below 13.50, send money out, but within reason, not everything. And I think we're back there again now today. If I listen to Tara's updates, and so that that's a good time if you need to get your offshore exposure. But I think be well diversified, be well spread, and don't be either or in your investment decision making. Don't be all in cash, all in shares, all local or international. You've got to spread it far and wide at the moment.
There we go. Warren Ingram from Galileo Capital telling us a lot of what we must not do, but then ending on what we should do. Good. It's not common sense, is it? It's insight. It's wisdom from Warren Ingram from Galileo.